Hello, learners. We have learned almost all the concepts which are practiced by a finance executive or finance manager. We have learned about theoretical aspects as well as quantitative aspects, that is, time value of money, cost of capital, capital budgeting, leverage, dividend decision, working capital management, and all those things. We also learned about capital market, money market, and certain techniques, how to deal with the retirement planning and all that. Now, today, I am with one more new topic, that is investment avenues and portfolio management. Now, you might be thinking why I am teaching you this particular topic within this particular curriculum. Just think of a situation that your parents, friends, or relatives, they come to know that you have studied financial management and they ask you a simple question: what are the different investment avenues? Number one. And number two, they simply want your advice where to invest the money or how to construct a portfolio. Similarly, you might yourself plan to invest your money or savings. For that purpose, you want to create a portfolio. So, that is the basic purpose of taking this particular topic in this particular curriculum. So, let us begin with what is the meaning of investment avenues and how, as an investor, you will design your own portfolio, or you can give an advice to someone who comes to you to seek the advice. Investment avenue is any place where you can invest your money, park your money. And you know, investment simply means sacrificing the current consumption of the money value for having some gain in future. It means if you have some savings with you, one alternate can be there with you to enjoy the utility out of that. Either buy the white goods or go in the market, enjoy it, or go for the picnic, buy FMCG goods and have the utility immediately. However, the moment you go for the investment, you are postponing the consumption of your current money for having some gain in future. So, that is how we define investment. Investment means sacrificing the current consumption of the money value to have some gain in future. Therefore, investment avenues are required. Investment avenue means where you can invest your money to have some gain. Now, different people visualize investment avenues from different angles. That means investment avenues can be classified into different categories and from different angles. If you see, investment avenue may be fixed or floating return investment avenue. I hope you remember when I was discussing you about the debentures or bonds or treasury bills or bank FDR. These are the investment avenues. If you invest your savings in those ones, you are likely to get a fixed return from the source where you have invested the money, or from the avenue where you have invested the money. That means you are the investor, an investee bank or investee company is bound to give you a fixed return in the form of an interest. So, an investment avenue in which investor is likely to get a fixed return month on month or year on year is called as fixed return investment avenue. Whereas floating return investment avenue, popularly equity shares, because in case of equity shares, no one promises you a fixed dividend. Dividend might be there, might be changing from year to year. And other thing, in equity, there is a probability of having capital gain also. So, that is floating return investment avenue. Another way of classifying the investment avenue may be security versus non-security form. Now, what is security and what is non-security? Now, here security does not mean safety. We are simply saying security form of investment are the one which are negotiable in nature. It means if you invest somewhere today in your name, tomorrow you can sell it in the market. Equity shares, bonds, preference shares, mutual funds. So, those are the avenues where you buy today and you can sell it after some time. You will be given some document or a certificate
that is the security form of investment. Whereas non-security form of investment is the one like you invest your money in the bank FDR, RD, which is non-negotiable in nature. So we can also say it is negotiable versus non-negotiable. So we have another type also, negotiable versus non-negotiable. Now you might be thinking why I have kept it at two different places. Look at the fact. Security form of investment are popularly sellable in the stock market, whereas non-security form are not sellable in the stock market. However, there are some non-security form of instruments which are negotiable also. Like certain mutual fund schemes you buy today, they are non-security form and these are negotiable as well. So that kind of differentiation is there. Then investment accepting organization might have an obligation or not. So we can classify according to that also. That means investee company directly or indirectly might have an obligation to pay you. So what I am talking about? Debentures, bonds, FDR. Whereas equity, investee company has no obligation. So these are the viewpoints I am telling you that yes, different ways can be there to classify investment avenues. Or these are the features we look for when we search for investment avenues. Risk is the inherent part of every avenue. You invest in any investment avenue, risk is the inherent part. Now again, this list you can keep into consideration if someone asks you a question, what might be the features or characteristics of investment avenues? So you can say yes, these might be the features or characteristics of investment avenues also. So this particular slide introduces you to the different ways in which investors classify the investment avenues and how we can say these are the features of investment avenues. We can narrate them. So risk is inherent part because every investment is for the future and the moment future element is there, risk is bound to be there. When I say risk, risk means probability of having adverse return or less return or a loss from your investment. Then maybe in an organized form or unorganized form. When we say organized form, you are investing your money in such a venue which is highly regulated like banks, financial institutions, stock market. Whereas unorganized, that yes, you are investing in certain avenues which are not organized. Organized means these are not tightly regulated. So there are some spongy schemes, kitty funds, chit fund companies. So in that if you make an investment, yes, chit fund companies are loosely regulated. So that is unorganized we can say. Or you can lend your money to someone who is not registered entity. Then again you are investing in unorganized form. Then yes, regulation is the prominent feature of investment avenues. So these are ways through which we can classify and see the features of investment avenues. Market oriented versus others. When we say market oriented investment avenues, such investment avenues, the value of which is easily decidable or available in the market. And these kind of investment avenues offer a quick valuation, like shares and bonds which are easily tradable in the market. So we can find out the value. If you have invested in gold, yes, we can get the daily rate of the gold. However, if you invest in diamond, yes, diamond rates are not regulated. They are not available for trading on any exchange, neither on commodity exchange or nor on the regular stock exchange. So we cannot find out what is the real price of the diamond. Similarly, property, we cannot find out. It is need-based pricing. So market-oriented investment avenue means the avenues for which a proper mechanism for valuation is available. A benchmark is available in the market. Whereas the avenues for which a benchmark is not available are not market-oriented but others. So this is the way different investors assign the features to investment avenues or they visualize the investment avenues from different angles. So this is the angle or perspective of the investors to see at different investment avenues. So a phrase might be there, how different investors visualize different investment avenues. Explain. And this particular narration we have dealt in past 7 to 8 minutes. Yes, you can say like that. And you are perfect in answering your things. Let us proceed further. Now, one structured way of classifying the investment avenues may be there, security form versus non-security form. When I say security form, I mean such instruments which are more or less negotiable in nature. That means one person who is the holder of the instrument can sell it to other person. These are assignable, sellable. Security form are money market securities, treasury bills and dated securities, commercial paper and certificate of deposit, and others I have also kept it. Others may be certain investment schemes of the banks or financial institutions which are in negotiable form. Capital market securities, equity shares, preference shares, debentures, and we might have others. Maybe mutual funds, yes, can be there. So these are the securities which are negotiable from one person to another person. These are transferable from one person to another person. Whereas if you see the non-security form, bank deposit, any kind of deposit, savings bank deposit, recurring bank deposit, FDR, monthly income scheme, they are non-negotiable in nature. Then post office deposits. In post office also we can have savings bank account, RD account is more popular in post office, monthly income scheme account is more popular among retired people for having regular income, so that is post office deposit. Insurance schemes. You can buy any insurance scheme. In general, those who buy the insurance scheme in India, majority of the people have the target to earn some return from the investment avenues. Safety is the other target because this provides you health and life risk coverage also. So there are ample number of schemes. Mutual funds, I have kept, we can keep mutual fund in both because mutual fund schemes, certain schemes are negotiable and certain are non-negotiable. So the one which are negotiable will fall in the security form, whereas the others which are not negotiable in nature, they will fall in the non-security forms. Similarly, schemes of non-banking finance companies. Non-banking finance companies are the one which provide different kind of financing schemes. They accept the deposit from the investors and collected deposits are used for lending purpose. Housing finance company, gold loan company and all that. But they are not like a bank. So you might have heard about gold loan companies. So these gold loan companies, hire purchase companies, lease finance companies, they all fall in the non-banking finance companies. So this is the way we can visualize different investment avenues, either non-security form or security form. That is negotiable and non-negotiable in nature. So those were the orientation about investment avenues. It means the avenues where you can invest your money to have some gain in future. Gain is never guaranteed, remember. 100% guarantee no one can give you, but yes, in certain avenues like if you make a FDR, yes, bank promises you they will pay fixed interest. So we can say yes, a kind of guarantee. Now before proceeding further, another classification we can have risk-free avenues and risky avenues. Although practically there is nothing risk-free in this life, but yes, certain government bonds, PSU bonds, they are called as risk-free. Treasury bills, they are risk-free. Whereas other avenues are the risky one. It may be bonds, debenture, equity shares or preference shares. So that is a little introduction about investment avenues, means where you can invest your money. So you must remember what are the features of different investment avenues. Then comes what a portfolio is. A portfolio is the bouquet of investment held by a person at a point of time. That is the one way to look at that. Another way to define a portfolio is collection of different investments held by a person at a point of time. These different investments may be either the financial investments like shares, bonds, debenture, insurance policy and something like that. Or it can be non-financial, that is real investment, property, land, building, gold, jewelry, precious stones, all those are real investment. So investment done by a person may be in variety of the investment avenues. And when we say at a point of time, portfolio will simply refer to the collection of the investment held by an investor at a point of time. So that is a portfolio. Now point comes, portfolio is always dependent upon two notions, notion of diversification and notion of negative correlation. Diversification simply means, general definition of diversification is investing your money across different investment avenues. In your schools you might have heard, never put all your eggs in one basket. Now think, what is the meaning of that? What message that is being conveyed? It means, I'll say, right from your childhood, people are telling you about the diversification. Then why don't we do diversification while creating a portfolio? Now when your teacher says in your school, never put all your eggs in one basket, the meaning is simple. If suppose one egg gets spoiled, it will spoil rest of the eggs also. Same example may be on apples, oranges. If one apple gets rotten, the same effect will be spread over the rest of the apples in the same basket. Or accidentally, if that basket breaks down, all the eggs will break down. You will lose everything, whatever you had in the basket. So intention was there, keep the things in a spread manner, so that if suppose accident takes place at one place, items at the other place are safe and you have some cushion with you, some money is left out with you. In the same way, keeping your investment across different investments avenues helps you in minimizing the risk, because every investment is subject to risk. Risk means probability of having a loss or chances of having a loss. So diversification simply means never invest your money in one single avenue. You can invest some of your money in bank deposits, some of your money in equity shares, some of your money in mutual funds, some of your money in insurance policies, some of your money in gold, some of your money in land and property. In that way, you have scattered your investment across 5 to 6 or 10 avenues. Now think of a scenario, because when it happens that crisis takes place in the market, one market might go up, another market might come down. So if you have a balanced portfolio investing across different investment avenues, then your risk is minimized. On the other hand, if suppose another investor is there, he did not follow the diversification, he did not believe in his or her teachers who were saying never put all the eggs in one basket. He invests 100% of her money in one single avenue, maybe gold, maybe land, or maybe equity shares. And all of a sudden a crisis takes place in that market and prices start tumbling down. He is likely to lose his savings, he is likely to lose his investment. So he is exposed to more risk. So if you invest only in one single avenue, you are exposed to more risk. Yes, chances of more returns are also there if that avenue does well. On the other hand, if a person is putting the investment in a scattered way, he is exposed to less risk, thereby chances of loss are less and he will have a balanced return. That is the meaning of diversification. Because diversification helps in minimizing systematic risk, non-systematic risk. Diversification helps in minimizing non-systematic risk. When you invest in the market, in any avenue, there are two kinds of risks, systematic risk and non-systematic risk. Systematic risk means risk resulting from the whole of the system, the risk factors which affect whole of the economy, whole of the nation and all the investment avenues. Like inflation. If inflation is rising, it will have negative impact on equity shares also, gold also, land prices also, thereby affecting the return. Whereas non-systematic factors are the one which are specific to one particular company or one particular investment avenue. So with the help of diversification, we can minimize non-systematic risk. We can minimize non-systematic risk. So that is notion of diversification. So diversification simply implies that portfolio should be containing a large number of securities. So why we have written securities? Because generally people consider portfolio means portfolio of equity shares. So if you are creating a portfolio of equity shares, invest across 10 to 15 companies which are manageable, and then is included in a portfolio, the non-systematic risk of the portfolio gets reduced. That means if 10 to 15 securities are included in a portfolio, the non-systematic risk gets reduced. Non-systematic risk gets reduced. So that is the basic concept of diversification. Now look at the fact what we have. If you go for the diversification, scenario will be like this. Systematic risk. Risk resulting from the factors which affect whole of the economy will remain constant if someone invests in one avenue or two avenues or three avenues or 100 avenues. But the moment you see the other part, this is non-systematic risk. This is non-systematic risk. If someone is investing in one company, his non-systematic risk is very high. Reason being, if that one company collapses, your whole of the investment might become zero. Whereas other person is investing across 10 companies, 15 companies, then slowly non-systematic risk declines. Reason is simple. If you invest in 15 companies, all the 15 will not do well, all the 15 will not do badly, few will do well, few will do bad, and a balancing will be there. So non-systematic risk means risk related to one particular company, industry, or one particular avenue. So diversification can be created across investment avenues and by investing in multiple number of companies if you are making a portfolio of equity. So that is the way notion of diversification works. Then comes notion of negative correlation. Notion of negative correlation simply means that while selecting the investment avenues, include oppositely correlated securities, negatively correlated securities, so that if one does well, another will do poorly, and balancing will be there, you are protected. So this is the way notion of negative correlation also helps in achieving the aim of diversification. Then point comes, if you have to design your portfolio or advise someone regarding the portfolio management, how it has to be done and what are the steps. Suppose I'll keep one hypothetical example alongside to explain this particular concept. Step number 1 in the portfolio management is deciding about investment objectives and constraints. It means a person is having 3 crore rupees just after the retirement. He comes to you and he says, where should I invest? And if suppose you give him a unstructured viewpoint or simply a loose viewpoint, which I'll say, not framed one or not skilled one or professional view, you might say him, okay, invest in gold because nowadays gold prices are going up, or invest all of your money or majority of your money in equity shares of so and so companies because these companies are doing well. But the moment you give that kind of advice, that might or might not work well. Reason is that you are not inquired from that particular person what is his objective of investment and what are the constraints. So if you are investing for your own purpose or for advising someone else, then definitely you should decide what is the investment objective, and then only you should allocate that 3 crore, 5 crore or 10 crore or 10 lakh rupees so that you can achieve the target with which you want to construct the portfolio. So always keep into mind, never go with the market trends that in the market so and so investments are rising, so let me invest in that avenue. Think what is your objective. think what are your constraints. So let me explain what are the different objectives with which investors invest their money. If you see, these are the investment objectives. Few people accord first preference to safety. Now, just to remind you, when you are going to invest your money or someone is seeking your advice for the investment purpose, his objectives may be more than one. He cannot have one single objective. Yes, ranking may be there, priority may be there, preference may be there. So, few people have the first objective as safety. When we say safety, they say, yes, I don't want to lose my money. My invested capital should remain intact. So if a person comes to you, he says, my first aim is security, and then second aim is regular income. So first is safety or security, and second is regular income. That is his order of preference. It means you will search such investment avenues which is safe. That means where the losses will not be there. His capital will be intact. And then that avenue should give him regular income. So you can simply suggest him, go for the post office monthly income scheme, because deposit in post office is 100% safe, and monthly income scheme gives fixed return every month. Interest you can get every month. Or other way around, he says my first preference is regular income and second is safety. That means he is a little bit ready to sacrifice the safety, but his first aim is to get the high regular income. Then you might suggest him, okay, go for the private company's monthly income scheme, private bank's monthly income scheme, where safety is little bit less as compared to the post office. So at a point of time, more than one objective might be there. Then capital gain. Few people don't require the regular income. They say my only single aim is appreciation in the invested capital. So suggest him, invest in the equity market, invest in gold, or invest in mutual fund for long term. Then tax savings might be the other objective. There are certain schemes of investment like PPF, Public Provident Fund. In that, if you make a deposit, you get some tax rebate in your income tax. Similarly, insurance schemes, equity linked schemes of mutual funds, all those offer you tax savings if you invest in those schemes. So few people might have the objective. First objective might be tax savings, second may be regular income, and third may be capital gain. So ordering may be anything. Then liquidity. By liquidity we mean the convenience or the ease with which you can quickly convert your investment into cash. So if suppose a company is there which is having surplus cash for the time being for 3 months or 6 months, they think that this cash, which is a huge amount, is not required for next 3 months because it is off season. So they can invest in such avenue but which is liquid enough. That means at any point of time, if they wish to get back the cash, they can sell back the investment and get the cash immediately. So their first priority is liquidity. Then speculation. Speculation means expecting disproportionate gain within a shorter time duration, on a shorter investment base. So speculator is the one who is aiming to gain from the price changes or fluctuation in the prices. So few people make the investment in the stock market like day trading or in derivatives for speculation purpose also. And then hedging may be the another objective. Hedging means counterbalancing the risk. To hedge means to check the risk or to counterbalance the risk. So if you already have a portfolio of the securities or gold, then to protect your investment, you can make another investment in derivatives market, options and futures, so that some kind of risk hedging comes from that investment. So these are the examples of investment objectives. However, one or two more or less might be there. Only point is that before investing your money, decide what are your objectives and what is the ranking order of those objectives. Now, once you have decided the investment objectives, we go for the next part, deciding about the constraints. Constraint may be there, immediate liquidity. So liquidity, For when I talked about liquidity under objectives, I was focusing on the companies. When I say constraint, I am focusing on individual investor. A person may be there, he says I need regular income or capital gain, but my immediate constraint is liquidity. Reason being, I might need money at any point of time. So his twin things are there. On one side, constraint is there as liquidity. On another side, his aim is there, regular income. So suggest him the avenue which provides both the features. Then taxes. Here when I say taxes, in objectives it was tax savings, here it is taxes. If you are subject to high tax bracket, your regular income is being taxed at a higher rate. So you will simply say, I don't want an investment avenue which gives me regular income. Because if you get the income, immediately government will take a high tax of 30% plus surcharge and all that, 33%, something like that. So you will say, I need capital gain. Because I want to avoid current taxes. I might pay taxes in future or at a lower rate in future. So suggest him long-term investment, because long-term capital gain tax is less and short-term capital gain tax is more. So that is the constraint. Time horizon may be another constraint. If you invest only for 6 months, 1 year, accordingly your investment avenue will be there. If you want to invest for a longer time duration, then accordingly your investment avenue will be there. Then unique preferences and circumstances. Few people might have health issue, family obligations for which money might be needed at any point of time in emergency. However, their objective might be capital gain or regular income. So choose the investment objective keeping into focus these unique preferences or circumstances. So a blend of objectives and constraints can guide you in the selection of the investment avenue, where to invest your money. Then comes the next 3 steps. So once you have decided where to invest your money, go for deciding the asset mix decision. That means how much weightage is to be given for each type of securities. Like if you are making a portfolio of securities only, financial securities, that is shares, bonds and debentures, then how much money will be invested in equity shares, how much in mutual fund, how much proportion will go in bonds or debenture. So decide the asset mix allocation keeping into consideration objectives and constraints. Once the asset mix decision is done, that means I will devote 10% to insurance, 30% to equity, 40% to mutual funds, 5% for the SIP and all that. Go for the security analysis or security selection. So this is security analysis also, security selection also. That means with the help of security analysis, you achieve the aim of security selection. There are 2 prominent things, fundamental analysis and technical analysis. Under fundamental analysis, what we do? We study the whole of the economy, whether the economy will be doing well or not. If economy is likely to do well, then we say yes, it is the right time to make the investment. Once we say yes, economy will do well, within an industry, we have many industries. Within an economy, we have many industries. So first we scan the economy. Once economy gives me an indicator, yes, I can invest in this economy, I scan the industries in that particular economy. There are 20, 50, 30 industries like paint industry, chemical industry, pharma industry, IT industry. So identify which industries will do well in the future. So let us say you select 3 industries that these are likely to do well. Why they will do well? Because they have the bright future, number 1. Number 2, they are in trend. Number 3, government is also promoting that industry. Like right now, government is promoting EVs, electronic vehicles. Now, once you have selected the industry, within an industry, within each industry, there are more than 1 companies. So make an analysis of the facts about the companies, that which companies are likely to do well in those industries. So finally, you make the selection of the companies which will do well, and then you can take the next step. So fundamental analysis includes analyzing the economy, analyzing the industries, and within the industry, analyzing the company that is your target to invest your money. Technical analysis. In technical analysis, you simply read the market trend, that how the prices are moving in the market, and that price movement is that likely to be bullish in future. Bullish means rising prices, or bearish means declining prices. So if technical analysis suggests that market will be bullish in future, you can invest right now. If technical analysis suggests that market will be bearish in future, you can wait, because prices will come down, they will correct, and at that time you can enter in the market. So these two things help you in security selection and market timings. Then execution and performance. Execution means if it is the right time to buy the shares, bonds, mutual fund, or if it is not the right time, if it is the time to sell, you can take a decision to sell it. That means ordering to a broker to buy for you or to sell for you. And then at the end, you will go for the performance check, because you will always keep into mind that did I achieve the objective for which I make the investment? If you have invested in the equity shares of 10 companies and aim of your portfolio was to have 20% return at the end of the year. So at the end of the year, you must make a check. Did I achieve 20% return? If yes, how I did do that? So that you are identifying the better points. If you could not achieve 20%, then also identify where did you do the mistake, so that you can improve for the future. So calculation of return and performance evaluation with the help of comparison gives you an idea, are you on track or not? It is like a control, check and balance. So that is the way the whole portfolio process is done. So once you have done your performance review, then again a question comes, if you did not do well, then you will revise your objectives, you will revise your constraints, you will revise your asset mix decision, security selection, and then again execution. So this becomes a cyclical process, the portfolio management process. So that is how we decide where to invest your money, where not to invest. So in this video, we learnt about different investment avenues, their features, classification, and as an investor, if you have to design your portfolio, how you can design your portfolio. Thank you. Thanks a lot.